Hello, everyone. My name is Lucy Moy, and I'll be your facilitator for today. Real Property Investments is an international real estate investing educational company. The purpose of our presentation is to educate international investors on opportunities on Australia, Canada, and the United States. Our company is 11 years old and was started by Monica and Von Jazik as a way to network and help real people build real wealth through real estate. We are now the world's fastest growing real estate investment community. We now have 31 chapters internationally. Before we continue, I want to let you know that you are in view only mode. And if you have any questions, please enter them into the question and answer box and we'll respond as soon as possible. RPI is dedicated to educate and empower people to take control of their investments and learn real ways to build wealth so they do not become a statistic, but instead are able to create freedom in their lives starting today. We present people with opportunities in Australia, Canada, and the United States. Today's guest is David J. Altman, who is a first vice president and director of the Marcus & Millichap National Hospitality Group. Since joining Marcus & Millichap, he has completed over $350 million in hotel transactions and analyzed over $2 billion worth of hotel properties throughout the United States. Using his geographical and analytical skills, he enjoys strategizing with investors to ensure that their hotels are achieving optimum economic viability in their respective markets. His careful attention to emerging trends and intimate understanding of the hospitality market provides owners with the most valuable, up-to-date market information. Mr. Altman has been continuously recognized by owners and buyers for his communication, leadership, and dedication throughout the entire process, which has resulted in numerous successful transactions. He's here to discuss hotel ownership for international investors.
Okay, so thank you for inviting me on here today to teach about the hotel industry. My name is David Altman. As Lucy said, I'm a first vice president of investments at Marcus & Millichap. I'm going to talk to you today. So I'm going to run through a little bit about my company, Marcus & Millichap, and then my team. And then we'll get into hotel-specific information, talk about alternative yields to hotels, and why hotels are a great product type to invest in. We'll go through hotel brands, various chain scales, what you should consider when investing in a hotel, how to underwrite a hotel, and then we'll look at a sample offering memorandum as well. So very quickly, Marcus & Millichap, for those of you who haven't heard of my company, we are a commercial real estate investment firm specializing in investment sales exclusively. We do not do residential. We do not do leasing. We are strictly investment grade properties. We have 80 offices throughout the United States and Canada, and throughout those 80 offices, we have 2,000 agents. Every single agent within our firm specializes in a specific product type. So of the 2,000 agents within Marcus & Millichap, we have about 100 that are hotel specialists. Now, our firm is one of the largest hotel brokerage firms in the country. And in 2019, our company sold 216 hotels with an average deal size of about $6.5 million. And nearly, as a firm, the hotel division did $1.4 billion in sales, and nearly $11 billion firm-wide, 1.4 in hotels, $11 billion in all product types. Just another slide identifying some of our competition, some of the other hotel brokerage companies out there, and we have almost doubled our nearest competitor as far as hotel sales. Now, I have a team here. I'm based in South Florida. I've got a team with several partners, and our team, we cover 16 states based out of our South Florida office, and every single agent on my team is responsible for a different region. So I cover most of the Southeast, the Gulf Coast region, but my partners cover different 3 or 4 state territories. This is important because hotels are a very national and international business, and buyers are crossing borders, as I'm sure you all are realizing being part of this presentation. So the hotel industry is unique in that unlike an apartment complex, you don't need to be within a short drive distance to manage that property. You can be on the other side of the world and manage a property virtually from a computer. Likewise, when we bring properties to the market, we're constantly reaching out to owners across state borders and international borders. The map on the left shows the states throughout the country, throughout the United States that we have done business in. And the map on the right shows the different geographic regions of our team. Here's some representative transactions that my partners and I have been involved in. You'll see ranging from 1 to 2 million, all the way up to 13 million, and we recently just closed on a $30 million Holiday Inn resort. You'll also see we primarily focus on the branded hotels. So Hilton, Marriott, Wyndham, IHG, and we'll talk a little bit more about that shortly. So why hotels? Well, as you see on this graph, this chart that is dated as of June 18th, 2021, cap rates vary depending on the product type. The more stable the asset, the lower the cap rate. The graph here, this matrix, you'll also see above it, you have alternative yields. So the 10-year treasury, as well as bonds and the different interest or different returns you can earn on those various investments. You'll notice hotels are at the bottom of the list, which means that you get the highest return relative to other product types. It's great, but that also means, high risk, high reward. Apartments, you are signing up, your tenants are signing up for monthly or annual leases, whereas in hotels, you are selling daily, nightly leases. So it's just something to keep in mind. So let's dive into the hotel specific. So like I said, I primarily deal with flagged properties. What that means is we're dealing with these parent companies: Hilton, Marriott, Wyndham, IHG Choice, Best Western, Hyatt, Radisson, just to name a few. Now, one of the questions you might want to ask yourself when you're investing in a hotel is do I want to invest with a parent company or not, or do I want to go boutique? That is something that we will discuss later on, but just want to highlight these are some of the parent companies out in the world. There's different chain scales that you might want to invest in. So you've got economy, mid-scale, upper mid-scale, upscale, upper upscale, luxury, and independent. Economy means lowest rate, right? So typically these are hotels in small towns and very rural markets. What classifies a hotel as an economy brand is entirely based on the rate. So typically these hotels are generating between $55 and $75 on an average day. Mid-scale hotels are typically in smaller towns, rural markets, and interstate, so right off the highways, and they're typically generating between the $75 and $95 daily rate. Upper mid-scale, suburban and small towns, so you're getting into larger villages, larger towns, getting $95 to $115 on average. Upscale are typically in suburban locations, generating between $115 and $140 average daily rate. Upper upscale, typically in larger cities, secondary cities, and business locations, so near convention centers, between 140 and 190. And then luxury is large cities, resort locations, and typically generating between around or north of $190 average daily rate. Independent is a brand. It's a subset of chain scale, so not a franchise property, but about 30% of the hotels in the United States are independently owned or independently branded, I should say. 99% of the hotels are independently owned and operated. Within these chain scales, so just to give you an idea of what brands you would recognize under these various chain scales. So economy brand would be a Roadway Inn, a Days Inn, a Travelodge. A mid-scale, Best Western, Quality Inn, Sleep Inn, a True by Hilton. Upper mid-scale is a Best Western Plus, and I want to note the difference there, right? A regular Best Western is a mid-scale, but a Best Western Plus is an upper mid-scale. Comfort Inn, Hampton Inn, Holiday Inn Express, a full-service Holiday Inn, La Quinta, Fairfields by Marriott, those are all upper mid-scales. Upscale, Best Western Premier. So again, we're still within the Best Western brand, but now we're on a Premier side. So they're getting a higher rate at that Best Western Premier franchise. Courtyard by Marriott, Spring Hill, Radisson, Crown Plaza. Upper Upscale, Embassy Suites, Full Service Hilton, Full Service Marriott, Westin, Le Meridien, Le Meridien. And then we get the luxury, and that's, Four Seasons, Ritz-Carlton, St. Regis, Waldorf Astorias. Within these brands, there's also a subset as well of extended stay, and I separated it because these different extended stay brands will fit into the mid-scale, upper mid-scale, upscale. However, I do want to put it off to the side because it is its own class. It's semi-apartment, semi-hotel, where you have extended stays. So stays for longer than a week, sometimes stays longer than a month, depending on where you are in the business that's coming in. But it operates on a different model than a traditional limited service type hotel or full service hotel. So I want to separate that out. So I'm interested in investing in a hotel. What should I consider? Keep in mind, you are buying an active and operating business, not passive income. So unlike a net lease property or an apartment complex, you are there on a daily basis, or you have somebody there on a daily basis operating the property. Staff, you've got housekeepers, you've got general managers, marketing team. It's an active and operating business, not just a real estate investment. It's more risk, more reward, as I stated earlier, right? The cap rates traditionally for hotels are higher, so you get a higher yield, but with that comes more risk. Again, to reiterate what I said earlier, you have nightly rentals versus monthly or annual rentals, but that typically means higher returns. So cap rates for hotels can range from the 7 to 11%. Leverage returns around 20%, and average cash on cash returns with leverage about 18% is kind of the airspace that we're aiming for. You should also consider if having a brand, a franchise, is important to you or not. Some things to consider: the location. So if you're an interstate hotel or looking at an interstate hotel, having a franchise is probably going to be more beneficial to you than being in an independent hotel. Whereas if you're in a downtown market, say a New York, South Beach, Miami, New Orleans, being an independent hotel, might be okay for you. Other things to consider: financing. So typically, if you're looking for leverage to purchase an asset, most lenders want a franchise or a flag on the property. It gives them some sort of sense of stability when there is a franchise on the property. So they typically require it, or will give you better rates and terms if you have a brand on it. You should also look at the historical operations of the property. Fees. So when you go to franchise, there are fees associated with it. You've got application fees, depending on which brand you're going to. So for example, Hilton by Marriott, as of today, the fee to apply for a franchise with Hilton or Hampton Inn is $175,000 US dollars. 10 years ago, it was about 50 or 75,000 US dollars. Best Western is about 35,000. Marriott is 125,000. Again, just to apply. So things to consider: royalty fees, marketing fees, other fees being technology fees, training fees, etc. The royalty fees and the marketing fees, you're typically spending 10%, roughly 11%, going to the brand off of your top revenue. So things to consider: different brands have different fees. And then change of ownership, PIP. This is probably the largest question mark in any transaction that you do in the hotel industry with a brand. Now, the PIP, or Property Improvement Plan, is a brand mandated renovation. I'll show you what one of those looks like later throughout the presentation, but it is something that needs to be known on the very front end of every transaction, because it can sway the value of the property literally millions of dollars. Another thing to consider, operations. Are you going to manage it, or are you going to hire a third-party management company? So if you manage it, that means you're going to be hiring and firing employees. Revenue management, you're in charge of changing the rates on a daily and hourly and even minute-by-minute basis. Marketing, auditing, night auditing, that's all on you. Are you willing to do that? Or will you hire a management company? With that comes management fees. And even if you do hire a management company, keep in mind you still will be auditing and watching over the management company's shoulder, so to speak, because they're not all great. They're not all built equally, and they're human too. They make mistakes. So you still want to be on top of them and make sure that they're squeezing every penny out of the hotel as possible. A way to kind of help make sure that they are the management company, if you do decide to go that route, is acting, as best as they can and squeezing every penny out, is ask them if they'll consider providing some equity into the asset, right? Giving them, 5% equity deal or slice. So they are part owners of the property. They want to see it succeed because the hotel's success is also your success and their success. So something to consider if you do want to hire a management company. So I'm interested in investing in a hotel. What do I need to look at? How do I underwrite? There's a couple must-have items, and I'm going very general. I mean, we can go very specific in here, but on a general basis, a couple items. STAR report, Smith Travel Research Report. One of the most important items to look at. I can value a hotel entirely on just this one document, and I'll show you what that looks like coming up. Profit and loss statements from the previous owner, as well as creating your own projections. If the property is listed on the market, you can ask the broker if they have any projections, but ultimately at the end of the day, you want to come up with your own projections. And if you're hiring a management company or interviewing management companies, you can ask them to come up with projections as well. And then the change of ownership, as I explained earlier, can range from minimal to millions of dollars and literally changes the value of a hotel. So we'll run through a couple of these items right now and show you what they look like. So this is a STAR report, Smith Travel Research Report. Fortunately, in the hotel industry, we are able to find out what our competition is doing on a daily basis and a weekly basis and a monthly basis. So in apartments, if you want to find out what your competitors are doing as far as monthly rents, you have to pick up the phone and you have to call your competition and say, hey, what are you charging for your 1-1s? What are you charging for your 2-1s? With hotels, it's all automated. And if you go with a franchise, you automatically subscribe to the Smith Travel Research. So for example, we're looking here at a May 2021 STAR report. That's when this one was released. For our Fairfield Inn and Suites, I blocked out some property-specific information for this presentation, but you can see here that occupancy for the month of May, the current month at this hotel, is 50%. The competition is at 72%. The index here is the penetration index. So 50%, when the comp sits at 70%, that means you're getting 70% of the market penetration. If the hotel was achieving 72% occupancy for the month, then the index would be 100%. So you can really see how a hotel is performing relative to their competitors. In some cases, that number, the index will be over 100, and that means that a hotel is getting more than their fair share of the market. Or in this case, when it's less than 100% index, they're getting less than their fair share. So we're looking at May here. So we have year-to-date occupancy, 43%. Competitive set is at 62%. And running 3-month and running 12-month. With the same columns for average daily rate, this hotel is getting a $102 rate. The competition is getting $122. And then lastly, we have RevPAR, which is revenue per available room. This hotel is getting $52 in revenue per room, and the competition is getting $88. So when I look at this, I say, okay, here's a hotel that is massively underperforming its competition. And I would question, why is it doing that? And how do I get it up to 100% index or 100% penetration? Towards the bottom, we have 2021 versus 2020. So we can see on a running 12-month, the property is down 15% in occupancy versus 2020 last year. Average rate is down, well, and the competitive set is down is up 5% in occupancy versus last year. So the top is current year to date. The bottom is relative to the previous year. So we just talked about a STAR report. Next item is the profit and loss statements from a previous or from a prior owner or projection. So I will share this. So this is what historical profit and loss looks like. So typically, if a property is marketed for sale by a broker, they will take the P&Ls from the previous owner and hopefully clean it up in a nice, easy to understand format. A lot of times P&Ls come in raw QuickBooks type style, and having it in this is called standard hotel format, where you have your departmental expenses, your undistributed operating expenses, and your fixed expenses. So in this instance, this hotel, 17, 18, 19, doing 3.3, 3.3, and 3.5 in revenue. We have their expenses throughout, and you'll see at the bottom, we have a 3% management fee and a 4% reserve for replacement included in. Now, we always include those into our underwriting because the bank will include those into the bank's underwriting. So when you're underwriting a previous owner's properties, even if they have a management fee and a reserve in their P&Ls, always remove it out and then add in your own, because theirs might say 3%, but it might be 2.5%, or it might be 3.5% or 4%. So standard is a 3% management fee or 4%, depending on the size of the asset, and a reserve for replacements is typically 4%. Always want to include those numbers in, and that's 4% off of the revenue, the total revenue. You'll also see we have a column here, the ratio to sales, PAR, that's per available room, and POR, that's per occupied room. So when we look through here, we can see, okay, per occupied room, hotel is spending $14.66 in 2017 on administrative and general. That's salaries for general managers and the administrative items as well. Typically, rooms expense is going to be housekeepers, front desk, staff. Those salaries are baked into rooms expense. But so what I'm getting at is you can see annually how that changes from $14 to $13.50 to $13.73. So pretty close to on par. Rooms expense, $44.17, $37, $38. So you can kind of get a good idea of how the property is performing. If you're spending more money in different areas than others, and just watch the trends. You can also you can ask your management company, if you're deciding to hire a management company, what kind of ratios and numbers that they are typically operating at. There is a report called the Host Report, which it's a survey essentially of properties throughout the country. And I'm trying to pull it up. So that Host Report will give you the average expenses ratio per available room and per occupied room for different various markets. And I will show you what that looks like right now. Sorry, scratch this. Okay. So limited service summary. Let's see. Let's go over to per occupied room. If you look down here at the bottom of tabs, we have limited, summary, revenue, ratio to sales, per available room, per occupied room. And this is, again, based on a sampling. So we have it based by region. So if we're looking in West, South, Central, we know that on a ratio to sales, A&G expense in this region should be about 9.5%. Your EBITDA after taxes and insurance should be about 32%. in this geographic region. If we're looking more at an urban or a interstate type property, our EBITDA can go from 36 to 31%. And so when we go back to here, we see, okay, this hotel is at a 22%, 24%, and a 25% EBITDA. We know, okay, there might be opportunities to minimize some of these expenses and raise our net operating income. And so that brings us to going back to here, projections. So when we look at projections, typically or hopefully there is a change of ownership PIP, a pro forma. And so you would take your pro forma numbers and say, hey, current hotel is doing $82 in RevPAR. We think we're going to basically stay flat and maybe do gradual increases in our occupancy and our rate over the next 5 years. So year one, $83 RevPAR, but we think we're going to cut the expenses down from $38 per occupied room to $36, from $13 per occupied room to $11 per occupied room. You just come up with projections like this based on the experience and the expertise of your management company to come up with a 5-year projection, as well as a rate of return analysis. So this looks like a lot. However, it's once you understand what you're looking at here, it's not that much. I'll do a quick kind of overflow or run through of this. So basically, we're saying if we purchase this asset at $12.8 million with a property improvement plan cost, which I'll talk about in a moment, of $650,000 estimated, with a franchise application fee, some working capital, financing costs, and some soft costs. Total acquisition price, purchase price of $12.8 million, but your total acquisition cost is $13.8, with a loan of 35% down, so $4.8 million down. You have a first mortgage of $9 million. First mortgage of $9 million at a 4.45% interest. That was the interest rate at the time. 30-year amortization, your monthly payment, and your annual payment right here in the top right. We then run through the principal balance portion. So year one, starting balance, your annual payment, how much is going to interest, how much is going to principal, and then your ending balance, and then cycling up towards the top, running down, going up to year 5. All right, we're ending our principal balance at $8.2 million. Yearly cash flow, so our current revenue, net operating income or EBITDA, with our first mortgage payment of $542,000, again, right up here, 542. We have $300,000 in cash flow after you pay your debt, with a debt service coverage ratio of 1.5 and a debt yield of 9.4. However, if we hit our metrics and our projections, years 1 through 5, these are our estimated cash flows after debt service and our average estimated returns as well. We also throw in our capital gain calculation. So in year 5, the hotel is doing 1.3 in net operating income, which is what we have right here in our projections. If we sell it for an 8.3 cap, that's a sales price of $15 million, 15.6, with a 3% commission to the broker. Net sales price of 15.1, paying back the remaining balance of your loan of 8.2. Again, 8.2, ending balance in year 5. Getting back that $4.8 million in equity that you put down right here at the top, $4.8 million. If in this asset, you should be, upon disposition, a capital gain of $2,100,000. Again, under the assumption you hit your projected numbers and COVID-19 doesn't happen again, right? Which then brings us down to the leverage return. We've got cash flow after debt service, cash on cash return of 12%, and cash plus debt reduction of 15%. So your leveraged return is 19.5, and your average cash on cash is about 14%. It's a lot of information, but it's a good idea, a good way to understand exactly what you're investing. And when you're investing in a hotel, you want to understand what it did, what it can do, what it should do, and then how do I get out of this, right? When I do decide to get out, what does my return look like? And based on the acquisition price of 12.8 and the property improvement plan of 650, it looks pretty good. Now, with this deal in particular, this is a deal we sold a couple years ago. So coming back here, PIP, Property Improvement Plan. And then this property, this example that we are going through, we have in here a property improvement plan of $650,000. The reality is this property, this is what the change of ownership PIP looks like. So so while we had an estimate of $650,000 on this property, it actually ended up being more like $1.5 million in a PIP, which drastically changes the returns as well as drastically changes the price point. So this deal ultimately sold for $11.8 million because we had to pull out that $700,000 in additional PIP. PIP is, so the brand, whenever a property changes hands, the brand, so in this instance, Marriott, will come in and do a inspection. And they'll say, great, you're buying the hotel, a bank's gonna give you a loan, that's tons of money that's coming into the asset. We want you to do all of these items, this whole list of things to get the property up to the current standards of the brand. Things like removing concrete wheel stops or repairing damaged curbs, to repaint the dumpsters, to ensuring new FF&E conforms to the existing decor package, replacing history wall in the lobby, installing new ceiling panels in the elevator, exercise room, expanding the fitness center to 450 square feet for hotels less than 100 rooms. This hotel was more than 100 rooms, so it had to be expanded to 600 square feet. That's a huge expense. You got to knock down walls and expand that fitness center. Restore the pool deck, repair tiling. So you can see these items can add up dramatically and can add up quickly. Replace mattresses. We're talking, 150 mattresses in this hotel. So when I say that this is the biggest item that can move the value up or down, literally it can be, I've seen PIPs. I've got one right now we're working on a property where it's $1,000. In this instance, we thought it was going to be $600 or $600,000, but when the franchise came back, they said, nope, it's going to be 1.5. So the other thing that's also important to note is the brand will never give you a value. They'll give you the list, and then it's up to you to go out and get quotes from different contractors, brand approved contractors, mind you. So important to note. And at this point, that's kind of the basics of investing in a hotel, kind of highlights the most important things to know. However, if there are any questions, I'm happy to answer any questions related to investing in properties or hotel properties.
Thanks, David. That was a great presentation. I had a question that came in.
Sure.
This is in regards, obviously, you mentioned the impact of COVID. So maybe you can speak a little bit about that, and as well on the flip side, where the current opportunities are.
Yeah, so impact of COVID, it's interesting. So last year in 2020, there was an indication that there was going to be an Armageddon type environment where properties were going to be given back to the banks and there's going to be tons of distressed assets. Well, that hasn't come to fruition because all the banks were giving some sort of forbearance to their borrowers. The reality is this wasn't an issue of operation mismanagement. It was an issue of a global pandemic. And I would say just about every lender understood that. And they didn't want to take over a property where they couldn't do any better than the current owner was doing. So a lot of the banks for a lot of hotels that were under the Small Business Association financing, so the SBA loans, the SBA actually paid 6 months of their principal and interest. So they didn't make any principal and interest payments for 6 months. Other properties that were with conventional banks or CMBS, their CMBS, commercial mortgage-backed security, it's a non-recourse loan. So they went into special servicing to get some sort of payment discount or new payment plan. And then the conventional banks typically, worked with the borrowers in their own forms or fashion. So all of that being said, because all the banks were working with their borrowers, there were no foreclosures. We were expecting, once the programs dried up at the end of 2020, we were expecting third to fourth quarter of this year for there to be some foreclosed properties and bank-owned assets hitting the market, and there will be some. But the industry right now is on fire. It's bounced back dramatically, so much so that a lot of properties that I'm talking to, a lot of owners I'm talking to, are doing better this year than they did in 2019 before COVID. All that being said, it's a hot market right now for hotel industry. Every buyer, every deal that we are working on, the buyers aren't even looking at the 2020 numbers or P&Ls. They're actually doing their projections and pricing out on a year one, a year two, a stabilized valuation, because they recognize that 2020 is the anomaly and should get back to normal within the next year or two, if not already back to normal.
Great. That was a great answer. Now, when you mentioned that they are recovering and the market is on fire, can you point out if there are certain areas that are getting the highest demand?
So Florida is highly sought after market. Texas is a highly sought after market. Those are really the markets that I'm mostly hearing about. I know, I mean, New York, you can get some discounted properties, but we're talking assets up in the, 20, 30, $40 million range. But it's overall, the whole United States is doing well, but I would say Florida and Texas are two of the hottest markets. And I think that has to do with the political leadership, not going into lockdowns and opening up earlier than some other states. As far as COVID restrictions, there's been a lot of leisure travel coming to Florida, which is why a lot of hotels here are just kicking butt.
That's great. It seems to be in line with the data from the rest of the real estate information community. So when you actually spoke earlier on the various, I guess, subsets or segments from economy all the way to uber luxury or whatever you called it, where would you say is where there's, again, the most demand?
So, yeah, I would say the economy mid-scale brands are, as far as pre-COVID numbers, they are back to normal for the most part. They're 95% what they were pre-COVID. The demand for purchasing assets, though, is typically in this upper mid-scale to upscale. But it also depends on the investor and their investment criteria, right? Some clients say, we only want to buy the economy brands because there's less expenses, there's less amenities that we have to provide, there's less brand standards when you're down in that lower end. So going to right here. So right, Days Inn, Econo Lodge, Roadway, they're not going to require as much from an owner as, say, a Marriott, a Spring Hill by Marriott, or a Hilton Garden Inn in the upscale sector. So a lot of investors like those because they cash flow, the brands kind of leave you alone. Whereas in the upscale, they also cash flow, don't get me wrong, but you also have to continually reinvest in your asset. So it really is just investor criteria dependent.
Okay, great. And you mentioned cash flow. I know in our community, cash flow is, a topic that many people think about. So would you be able to give a range if somebody is looking to invest in a hotel chain, regardless of where they are, kind of what they can expect to make on an investment?
Yeah, so as I stated earlier, if we go back to this slide, right? So tier 1, tier 2, tier 3 cap rates. So tier 1 would be a downtown urban market, New York City, downtown Miami, right? These are the large luxury and upscale assets, full service, Hilton, Marriott, Ritz-Carlton, right? They're in this low 6.6, and sometimes even lower than that. Sometimes they get down to like 3 or 4% or 4 or 5%. This tier 3, 9.2, that's traditionally where that's going to be more like the Best Westerns, the Hampton Inns, the Holiday Inn Expresses, things of that sort. It's as you get down the line, right, towards more economy branded Days Inns, Econo Lodges. I mean, that's getting even further up towards 10 caps and in some cases even 11 caps, depending on where you are and how volatile that market is, right? If you're in a market that is oil dependent, right, and oil prices have been going up and down, it's a little bit more volatile. So, the return is going to be higher because the risk is higher. But I would say, on average, cap rates in the 8 to 9% range. Projected, right, when I'm looking at year 2, especially right now in this post-COVID world, year 1 or 2, I would say I'm looking at a cap rate in that 8 to 9% range post-PIP. So keep in mind, as I said earlier, the PIP can sway millions of dollars up or down. So you want to be, you might be buying it at an 11% cap rate on the existing numbers, but after you factor in that $1 million PIP, the cap rate is obviously going to be compressed down to probably this 9% range. And then the other thing I would say too with that is, I lost my train of thought. I lost my train of thought. I'm sorry.
I think you did a great job answering that question. Another question just came in terms of, like you mentioned, the extended stay and the hybrid model between daily rates and people staying obviously longer term. Do you see that this is a model that they're going to be, it's a profitable model? Obviously, there's some pressures from the Airbnb side community, or probably not, I don't know. Maybe you can speak a little bit on that in terms of this idea of the short-term rentals kind of merging in with some of the other things that are happening in the market.
Yeah, so short-term rental, I don't really have much experience with per se. And when I say short-term rental, I mean like single-family homes doing short-term rental, or apartments or condos. When it comes to an extended stay hotel, so one thing I can show you, like we said on this Host Almanac, right? Typically an EBITDA for a limited service hotel, 36%, somewhere in the 30s is kind of, this is what the Host report says. The reality is most of the properties that I'm looking at, their EBITDA is, if they're getting 30%, that's kind of the metric I use. 30% EBITDA is a nice, well-operated hotel. The lower you go, if you go below 20, I would say there's some management issues. If you're going above 30, I'd say that the hotel is just kicking butt and doing well. When it comes to extended stay, because you don't have housekeepers going into the rooms on a daily basis, right? They might go in twice a week. You also have less amenities. So typically with an extended stay, you're not offering breakfast. You might have a coffee table in the lobby or something of that sort. So your expenses are a lot less with extended stay hotels, which is why that is a hot market in the hotel sector, because the EBITDA that you're getting on an extended stay is sometimes in the 40 to 50% range. So you get a higher return, which means that the cap rate is going to be a little bit less as well, because it's a little bit more stable. You're selling weekly rates or monthly rentals instead of the nightly rentals. Again, depending on location. So it always comes to, real estate is all about the real estate, right? The location. So depending on the location and how much actual extended stay business they're doing will determine if it's a good investment as an extended stay or not.
Great. Thank you so much. I'm just checking for last minute questions. I think we're good. Thank you.
Absolutely. My pleasure. If there are any more questions, obviously, I'm happy to follow up and answer any questions anybody else has.
Great. Thank you so much. All right. Thank you, David, for today's presentation. And thank you, everyone, for attending our event. We hope you found it educational. Don't forget to add us on social media to make sure you are notified of upcoming events, webinars, and real estate updates. Thank you so much.